there was something, all of the like the growth stocks. And the reason I like to watch the growth stocks is, to me, they're like the canary in the coal mine. They're the most sensitive on the way up and on the way down because they're also kind of, beta names, of course. And so, not all of them, but let's say Viav again. This closed down even with the market trying to attempt a rally here. So that was like a really interesting tell. Same thing, like see Caterpillar that had a small update, but Coherent, which is up today because of S&P 500 inclusion. Again, all of the really some of the strongest names had a lot of weakness on that market rally, which was pointing to just to your point, reading the tape. That was an interesting change of character from what we were expecting earlier in the week when there was a lot of support buying come in. So especially in these news driven environments, is very much a day to day type of read. So markets continue to get battered by oil prices rocketing higher thanks to the U.S.-Iranian conflict. What we want to look at today is really trying to figure out what are the key data points, key tools we're looking and watching to kind of figure out when it kind of makes sense to start stepping back into the market or getting a little more aggressive, or just a different kind of flavor of what to watch and pay attention to, just besides staring at the NASDAQ price all day long. I'm Matt Caruso. I'm a co-host here with my good friend Jason Shapiro. Jason, how are you doing today?
Good, man. Let's call it the U.S.-Israeli-Iran conflict.
U.S. Okay, more accurate, I'm guessing, right?
I think so, but what do I know?
So last night, so pretty wild. So obviously, all this kind of centers around the whole Straits of Hormuz being closed or quasi-closed or worries of it being closed. Instead of going over the same kind of talking points that so many people are talking about, I want to look at a few different data points in the market that are very relevant to what I'm going to be paying attention to. First is something that I shared a few weeks back that's been tremendously helpful. I'm just get the screen share going here. And this is something that I've always watched for quite some time. It looks at the QQQ versus the XLP. XLP is consumer staples. And so I don't use it for direction necessarily. And so basically, you can see the ratio down here. When the ratio is climbing, it means consumer staples are doing better than the NASDAQ, which is obviously not what you want to see in a healthy market. And this is really something we spoke about a while back, right when we started this podcast, way back when this was kind of getting nasty. And it's not so much about markets having to go into a bear market, it's that you're going to be in likely a difficult market environment. If you go back over time, all the really kind of difficult, obviously this was like a nice downtrend, but even these very wild and erratic, choppy type of markets are usually hallmarked by the staples. The purple background is indicative of when this ratio is above the 50-day average. And it just typically highlights when you're probably going to be in a difficult market backdrop. And so a lot of what I do, we came in last week. The title of our podcast was Buy When the Missiles Fly. That worked for about, 30 minutes. And then people started to get worried that the straits were actually going to close. Actually, no, sorry. Tuesday, we had a big update. But then Wednesday, we had a big update. And then after we had the bad break into the end of the week. But that's really what this ratio highlights for me. Not so much direction, but for a lot of people like you and I, where we're trying to put on positions for extended periods of time, it's not just about the right place to buy. Because, funny enough, we were talking about two trades a couple of weeks back. I was looking at FCX, which was strong in this area, and you were talking short the Aussie dollar, AUS, USD, right? And, we were joking this kind of stopped you out, and I was an FCX, and then that stopped me out, which is, I think, the perfect real-time example of why this market is difficult, because we both had opposite sides of the trade on, and we both got stopped. And I think I was maybe near a break even or a slight loss, I forget the exact numbers, but just highlighting the difficulty of this kind of market. So this is one of the indicators I'm going to be watching very closely. And for perspective, if you take a look, this is 2025. Let me bring back the triple Qs in the top thing here. It doesn't nail a bottom, but it's really kind of trying to give you that idea of what the market dynamic is doing. So this is something that's been very helpful to me. Something else I want to bring up as well, another really helpful tool that I've used for the longest time. And that's where we can take a look at some of the others that you want to bring up. This one here. William O'Neill in his book, one of the tools he used was, he called it the up-down volume ratio. Basically, he looks at he looks at usually a 50-day period. He looks at the volume on up days compared to the volume on down days. And if there's more, if the sum of the up days is greater than the down days, there's net buying or it's net selling the other way around. And I kind of shortened that to a 20-day type of situation here, a 20-day look back. If I like to have guardrails on just to keep me out of trouble from making the biggest mistakes. And so I have a couple of those guardrails. The XLP ratio is one. This up-down volume ratio is another. And all the kind of the really steep problematic market environments are usually hallmarked by these not being helpful. You can see here we are below one. When you're below one, you have a white background. When you're above one, which means, net buying, you have a green background. No perfect indicator. It's just about kind of knowing when to stay out of trouble. You can see if you just kind of stayed on the sidelines until you got the all clear. Not that it was a buy right here, but now you can start considering buys. You would have sidestepped all the trouble, the stuff that really kind of gets you hurt and can be the big problem driver. So this is one where this can turn around really quickly, but still below that one mark, which is the black line. So these are two really, I think, helpful tools because one shows direction, one shows the difficulty of the market environment. And I use both of those together. And something when I want to look at, I know you look at the COTs, we could look at some different things as well. But for me, whenever I look at data, I want to avoid reusing the same data in different ways. So, technical analysis, we always joke about how it could be so misused and all the rest. And if you just bring up 10 price oscillators, an RSI, a stochastic, it's taking the same price and just remanipulating it with a slightly different formula. So looking at the ratio, which we looked at before, that looks at the relationship between the Nasdaq and consumer staples. Here we're looking at how price and volume is reacting on the index. And so trying to boil down to how do we get different snapshots of data to give us maybe a fuller picture of what's going on. So before we get into the macro and the headlines and all the rest and what can be and what cannot be, these are a couple of tools I want to kind of come out of the gate with here and share, and some we can kind of follow week by week. And for those who follow us week by week, we can kind of get a good idea of what's going on. And these are two key variables I'm going to be watching. So I'm curious, Jason, in this environment here, is there anything you want to bring up that we can take a look at that is kind of like a go-to for you to kind of give you a sense of trend or general
I mean,
direction?
my go-to is always the positioning data, always the
Mhm.
COT data, and what we have seen. And look, we've been doing this now for a while, a couple months. I think that we have gotten some things right. I think that we have gotten some things, well, let's not say right or wrong, but I think some of the things that we talked about worked. And I think some of the things that we talked about didn't work. Normal. Um, but I would say one theme that has been through this entire thing was that these are very tough times here, and this is not a time to be aggressive, and this is the type of market that will whip you around. And I think that's probably the most accurate thing that we have come across, that we have said during this thing. And why is that? For me, it's a combination of, and I think all of this is a combination of data, which you're showing some data that works for you. I like to look at the commitments of traders data. What the commitments of traders data has been saying for a while now is that there is nothing. There's nothing. So therefore, for me, there's no edge. So therefore, for me, there's really nothing to push the markets one way or the other very big. So therefore, it's probably going to be range bound type of trading. And we've been saying this for a while. This data has been saying this for a while. And way before the war or whatever you want to call this thing. That's the first level I look at. And then the second level is I always am trying to monitor sort of the psychology of the participants and listening to what they're saying. And I kind of hear the same thing, as I've been sort of saying for a while. It's like everybody is so one-sided or the other sided, right? Um, Either this is the greatest buying opportunity in history or the market's crashing. It's probably neither, right? Either oil is about to go right back down to 60 or it's going up to 250. Probably neither, you know. Um, and when you have that kind of stuff going on, it's probably neither, which means that it probably just range bounds and whips people around. And which is exactly what's going on, and it also kind of makes sense from a point of view of the markets are pretty efficient. I think that they are getting every minute of every day more efficient, and particularly because of the things that you can do now, very quickly. You know, you can back test stuff now or test any kind of data set now. Shit, overnight, man. You know what I mean? You put that whatever that new thing is, what a claw, whatever, to work.
Yeah, that's right. Open claw, I can do
Open
auto.
claw, you put that puppy to work, and by the time you wake up in the morning, it's got all the answers to all your questions, right? And that's all fine. The market's always been relatively efficient, but we've had a period where there was massive liquidity pumping, and that pushed asset prices like stocks up. And now that's maybe kind of over-ish. So what is going to push stuff one way or the other? I don't know. And that means that we're going to have pretty efficient markets here, and it's going to be pretty tough. And that's what's been going on. You think it's efficient. Oh, software, blah, blah, blah goes down, and then it goes up. Software underperforms the hardware. And then as soon as you see that, the software outperforms the hardware. Why? For no frickin' reason, you know? You can say oversold, overbought. And, that's really my point here is that I've said it a million times. To everything there is a season, right? This sort of selling overbought and buying oversold stuff has worked recently. Whereas other times, buying overbought because you're buying trend works, right? Sometimes this works, sometimes that works, sometimes. Works. And it's important to know that. We talk a lot about reading the tape, and we give a lot of examples about reading the tape and, what's it saying. In my view, reading the tape the last couple weeks, in particular last week, was horrible. Because it gives you what they call traps, bear trap, bull trap. There's a reason why. There's a name for those things, and it's because they do happen. I would argue I would lean towards reading the tape 99% of the time, and it maybe works 75 to 80% of the time. Keeps me on the right side of the trend anyway, right? But there's that other 20% of the time where it doesn't work. And that's nothing works all the time. Nothing. Zero things work or have ever worked or will ever work all the time. And so you have to know if you have something that works over time, there are times when it's not going to work. And most likely when you least want that to happen, right?
Yeah.
And when it's going to start working again after it doesn't work is when you've given up on it and then it starts working again. That's just human nature, right?
Well, it comes
So,
down. That's where it comes down to kind of persistence, running a business. It's like I always tell people, if you want to sell toys in January, you're not going to have very good business. You know what I mean? Like your season is in the fall when it's before the holidays type of thing. You have to respect that. If you get angry in January because you're not selling toys, I don't think you ever will.
no, that's right. But to me, it comes down to risk management. Yeah. Know that whatever you're doing might work over time. Hopefully it does. But even if it does, it's not going to work all the time. And that's why you have to always be in the risk management mode. I know you want to make 5 times as much when it's working, but then you're going to lose 5 times as much when it's not. Okay. So unless you're ready for that, then you're not going to get the other one. And I think that's the important thing. You were talking about like this last week. Okay, when did this Monday, did this Tuesday, did this Monday. Monday, the tape would have said buy the hell out of the market, right? We came in, the market gapped down, it closed on its high. And we talked about that. I
Hmm.
kind of thought that it was going to be a fake move. Tuesday, we came in, it gapped below the Monday low. Ooh, I was a genius. It was a fake move. Except by the time Tuesday was done, you got half of those losses back anyway. And then
Yeah.
Wednesday came, Korea was down 12% overnight. And the markets ripped and the NASDAQ ripped and they closed on high. So again, Wednesday, you'd be saying, oh, this tape is great again. Right. So Monday was right because Wednesday's right. And then what happened? Then Thursday and Friday, it all got shocked,
Well, that's about like respecting the market, and so much of this kind of comes down to all the old sayings like Druckenmiller or what, like when you're right, you go for the jugular, and this, like when you're in the right environment, you press, and when you're not, if you are going to participate, which I think most of us, anyone listening to this podcast probably loves trading for more than just making money. They actually enjoy the process. So we all tend to overtrade. It's just, I think, a natural part for most people. And so, but a big part is if there is that element of what you're doing, at least be small when conditions aren't right. And that's why over time I've tried to build these like objective ways. It's not about always back testing. For me, it's about just kind of, like that, for example, looking at the triple Qs versus the XLP. It's like, hey, Matt, if you're struggling and then that ratio is showing you that it's a tough environment, you're probably in a tough environment. Your P&L is telling you that, the ratio is telling you that. You shouldn't be on margin in this environment. That's for sure, kind of thing. So for everyone watching it's really about this understanding yourself, understanding the market, having some important guardrails to prevent yourself from going off. Then, I mean, I don't know if it's happened to you, Jason, but you get stuck in a range like this, and then the anger sets in, and the revenge trading sets in, and you look back, the market went nowhere for 2 months, and you obliterated your account, and you say, "What the hell did I do over the past 2 months?" It's real, man, and you have to really guard against that. It's a dangerous thing when you're active trading.
Has it happened to me? Yes. Will it ever happen to me again? Has it happened to me in 25 years? No, because it has happened to me, and I'm not gonna have that happen. I mean, this is why I then develop a process that, and I always say one of the I think probably the best part, quite frankly, of my process is not its ability to predict the future, predict what market's gonna go, but to keep me out of trouble. And that's what it's doing here.
Well,
Like I
what I
said,
like about your process is so I would argue it's so strict in a sense, like the way you look for news failure, but it has to be positive close on the day. Like those are like some really like I mean, I've learned so much technical analysis, and that was like a really strict requirement. And I'm sure for many people who listen, for me, it was a little bit of an aha moment. Like I really loved when I heard that process because it was different from what I've heard before. And it just kind of especially just nails the I want to say no most of the time unless the odds are really stacked in my favor. That means trading a lot less, and people have to be okay with that if they follow that process. But generally, you should be saying no more a lot more than you're saying yes, which is the problem probably most people face.
and listen, does it keep me out of trouble over time? Yes. Does it also mean that I miss trades? Yes. I've been talked on here a few weeks ago about sugar being the most set up trade in COT. I never got my news failure. Buy. I never got it. I never got long sugar. Well, look at it now.
People,
Do I wish that I got long sugar somewhere? You bet your ass I do.
yeah, yeah,
No, but the reason I did not get long sugar here is the same reason why I didn't put on a lot of trades that have not worked. Like this is what all of this is. There's no magic, right? One
hmm
side, the other. I could be looser with my getting in and getting out, and I would have caught this trade. But then I
hmm
would have had a bunch of losing trades that I didn't want, right? Um, so that's just the name of the game.
yeah. So looking at the oil market, which is kind of the tail wagging the dog of the world right now, I think one thing that we have to kind of pay attention to here is there's so much discussion about this. Well, what kind of causes downside reversal? If we bring up the actual price of crude here, which is a pretty wild session, I saw this last night. I was up near 120. Is I'm sure many have heard this by now, but G7 countries are considering releasing 300 to 400 million barrels from the strategic stockpiles, which is interesting because last week, and this is, I think, a good lesson about how markets will bend politicians to their will a lot of the times. Last week, a few different politicians said, there's no way we're releasing anything. There's no need. We're not going to do that from the strategic reserve. And here we kind of go right now with what's kind of that discussion that's coming out.
You
So,
probably should have known right then and there that they were going to.
yeah, right. Right. So what kind of makes it difficult, I know today, if we take a look at the cues, no, we did gap down. We're rallying higher a little bit. To me, the key issue here is the amount of news in the cycle that's going to be coming back and forth. Even if they do release that oil, 300 to 400 million barrels, if you do the math of what's kind of shut in from the straits, that buys 3 to 4 weeks of the down, the drop in oil production that will be replaced by the strategic reserve. When you get to war's a messy thing, man. So, like, the way I look at it is, if I was Iran and I put myself in their shoes for a second, this would almost kind of embolden them a little bit because it gives them a clock. If I could run the clock out for 4 weeks, well, then suddenly, my enemy's going to have much less options. So, I think there's going to be a lot of back and forth in the next few days, gap downs, gap ups, which I think for some people they may not be used to it. But my go-to chart, and I think everyone has a market, one that I have PTSD with, is 2011 when there was the U.S. Sorry, not the U.S. The European debt crisis. Remember back then they were calling them the pigs: Portugal, Italy, Greece, Spain, and all the rest. And I had a great 2010, even trading at the bank and all that. And this was just younger and expecting this to always kind of persist, and then getting really smashed around it. This was like probably one of the toughest years I ever had. For those who are not used to, because we've had certain markets recently where either they're just trending down or trending up. Even the tariff thing was downtrend, then we kind of bottomed, ripped uptrend. You have to be prepared sometimes that you may go through something like this. I always kind of will tell members, clients, you know, if you want to stress test your ability with a trend following process, which is what we do, to not get caught up or run over, I said, go look at this 2011 period. First of all, if we kind of zoom out a little bit, this began in February of 2011. We only ended in December. This was the whole year. And there's so many deceptively difficult points here This high in April took out the early February high. So, oh, breakout, here we go. Then this breakdown broke the March low. Well, things are going to be bad now. We ripped back up to new highs twice, only to waterfall down. And then look at this. Just look at this day to day gapping up, gapping down insanity. And so this is something to be aware of because again, back then that was very much in like the politicians trying to react to what the market was forcing them to do. Bond markets and all the rest were having these dramatic moves. I don't remember there. One of my closest friends, another trader, he's Greek. And at the time, there was the Greek finance minister. He'd come on CNBC with his leather jacket, and we just used to die of laughter all the time when he'd get on with that leather jacket. But and so this like back to back stuff is something you have to be aware of, that this can be an outcome. What feels like, oh, the bottom's in, the top is in. It's just a very a difficult market for a while. So I mean, I'm optimistic that we'll get some kind of resolution, but we have to be open to being able to kind of navigate these different markets until we get a little more of I think a reduction in volatility. I've never seen a big uptrend kind of come without a reduction in volatility. And so you can see just the size of the trading ranges once trend took hold, how that's dramatically different from the size of the trading ranges when you were within the range. So something I watch it, and number one, that makes it easier to buy and sell because your risk is lower because the volatility is smaller, and it's more likely that you're entering into a trending environment. So trying to have these tools to kind of slow your process down until all the ducks get in a row, I think is going to be super important.
Can you back that up again? Make it like a little longer, yeah. No, but get the other part in there too when it finally did break out for real.
Yeah.
Yeah, I mean, you're telling me who in their right mind, after dealing with that whole year, like you said, it made a new high here, it made a new high here, it made a new high here, all of them were false. Who in their right mind is now buying that last breakout in February?
Nobody.
You know what I mean? And then that's
Yeah.
why it works, right?
And nonstop. Look at this, nonstop, day by
Right,
day,
right.
ripping in your face. And if you're waiting for a pullback, you never
And you're
got
dead.
one.
Right.
Never got one.
Because you got them all over there.
Right.
You're waiting for another one of those.
Yeah.
It's not an easy game, man. It's just not easy. I feel as though clearly this oil thing is driving people's psychology in the market here. I think that's kind of why the tape was so theoretically unreadable last week.
Hmm.
From what I saw, including what we said on here, I forget what your line was, buy the missiles fly or something like that.
When the missiles buy when the missiles fly.
Right. So I think that people have been very programmed
Hmm.
to believe that when the war breaks out, you short oil. You short the spike in oil. It
Hmm.
worked. It worked in Kuwait. It worked in Iraq. It worked in Russia with Ukraine. It worked, I think, on the last one when they went and bombed Iran. People have been programmed to do that. And then if you look at what oil did last Monday, it gapped up. And if you sold it Sunday night on the open, you did very well by the Monday close. So it looked as though it was business as usual on that, except it wasn't,
Hmm.
right? And if this was just my read on it, and if everybody sort of believed that oil was not going to be sustainable to the upside, then why the hell would you short stocks? Why wouldn't you buy stocks, right? You
Right.
want to be loaded on stocks so that when oil comes back down and the stock market rips, that you use that dip as an opportunity to do that. And that's why I think the market was holding in, because no one believed that oil was going to do that. And then when it did do it, obviously on Thursday and Friday, that's when the stock market sort of cratered, right? So it's almost like the double
Hmm.
bluff psychology thing that I think is going on here. Um, and I don't really think, for me at least, it doesn't offer me any value in saying, well, if oil goes up, then the stock market's going to be in trouble. And if oil goes down, then the stock market's going to be okay. Because I don't know what oil is going to do.
Hmm.
You know, so if you could tell me where oil is going to be in a week, then maybe that would offer me value. But we don't know where oil is going to be in a week. So, like I always say, when the market does what it's expected to do based on this, I don't know where the value is. That's certainly the big narrative here, though. So, what's interesting to me is to see when the market does what it's not supposed to do.
Yeah.
Let's say oil continues to go up, yet the stock market doesn't go down. Okay,
Hmm.
there's a message, right?
Hmm.
Or let's say oil does come off and the stock market continues to go down. Well, that's a bad message, right?
Yeah.
I don't know which one it would be. I don't know if either one would be, but that's the kind of thing that I'm looking for. If you were bearish coming into this, I kind of was. Um, hasn't done me any good necessarily, but the market hasn't gone down a lot. But um, maybe the market was going down for other reasons,
Hmm.
and this noise came in. Okay, that's created a bunch of noise. But if that were the case, then if it started to go down even when oil stopped going up, that would kind of be the tell, I think, that that is the case. Um, so let's see, oil started coming down today, obviously way off its high, big reversal day. Everybody sees it, right? And the stock market came back very strongly. Except now it looks to me like it's kind of starting to fail again. If you have the
Hmm.
intraday chart there, the day ain't over yet, but to me that's how I'm looking at the stock market here.
Well,
How
a
is it
couple a
good?
couple of points you bring up are it's really interesting because even with oil, and this goes kind of like, it's not the same, but it's similar in concept like news failure. If this was that gap up and we sold off, then the high of that bar shouldn't have been breached. So, already
Correct.
on Tuesday, there was kind of signs of issues. And so again, I was kind of pressing ideas on Monday and Tuesday, there was a really important change of character. I want to kind of highlight here. This is something I've been speaking to with members. Where is this here? Let me bring up here. So if we take a look in the bottom panel here, I'll put in the triple Qs. And so if you take a look at, all the strongest stocks we've been speaking about like all year long, like let's say Corning. So this is just close only, just to keep it really clean. Just we look at the closing prices. Look at on Wednesday, when the triple Qs had this big up close, yet Corning closed lower. There was something, all of the like the growth stocks, and the reason I like to watch the growth stocks is, to me, they're like the canary in the coal mine. They're the most sensitive on the way up and on the way down because they're also kind of beta names, of course. And so, not all of them, but let's say Viav again. This closed down even with the market trying to attempt a rally here. So that was like a really interesting tell. Same thing like see Caterpillar that had a small update, but Coherent, which is up today because of S&P 500 inclusion. But again, all of the really some of the strongest names had a lot of weakness on that market rally, which was pointing to like just to your point, reading the tape. Um, that was an interesting change of character from what we were expecting earlier in the week when there was a lot of support buying come in. So especially in these news driven environments, is very much a day to day type of read. But something I want to kind of bring up as well, just to look at a previous point in time of what to kind of envision as possible. That's why I like to kind of just go back at other periods. If we look at oil in the top panel here, and we look at the S&P, if we go back to 1990, so right now it's about 20% of the world's oil at risk. I'm just rounding here. 1990, when Saddam Hussein invaded Kuwait, he was going to have about 20% of the world's oil under his control. And so when he during that invasion, we had this big sell off in the market as oil kind of went from 16 to 40, and that was a 20% S&P 500 sell off. Take a look here. We're down maybe 5% from the highs now. So again, there's resilience, but if they can't get the reserve, or even if the reserves do come out like they're talking about, and the market still goes lower, this is just kind of like a base case I'm trying to kind of look at. And one thing as well, I just want to kind of point out is the U.S. only got into Iraq in I believe February of '91, but the market bottomed way ahead of that in anticipation. So there's just so many different elements to this. Very hard to buy the down tick because things still look terrible when they're falling. We can go further than we think. And usually by the time the market's going to be healthy, you'll already see some improvement in price action. You don't need to buy that bottom tick to then get a lot of good upside. So for anyone who wants to kind of see another environment, if you weren't aware, if you don't remember, I think taking a look at 1990 with the rally in oil and the Iraq war is probably a good case study to look at.
Yeah, I think that the story here is have your powder ready. There's going to be opportunity. Okay. I don't know if fooling around right this minute, right today, in the midst of all this is the way to do it. I don't think it is. Um, what I said to my guys last night was, patience, 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 and then pounce.
Yeah.
I don't know if this is pounce time. Have powder dry because there is going to be opportunity. This will create opportunity. and it might not be today. And I know we all want to trade today, but if you're smart, that's not how you do it. You wait until the opportunities present themselves, and you just do your work now so that you're ready for where you think the opportunity will be. A and B, what would get you to pounce? I
Hmm.
can show, for example, the things that I'm looking at based on what I do, which is like in the energy space. If I wanted to be short the energy space, I think the best place to be is the unleaded gas, which I'm just looking today. Crude's up 4.5%, unleaded gas is up 2%. If you look at the unleaded gas futures, I don't know if you can, but the positioning, that's where the positioning is the most extreme.
What's the symbol for that for unleaded gas again? RB. Okay.
Right. So you see, the green one is the speculators, how long they've gotten that one. Right.
They caught a good trade though. Whoever put that position on.
Yeah, they caught a good trade because they caught a war. But yeah, no, that's right. They did. And look, that's trend following. I always say trend following makes money over time. Okay. They catch good trades, but when it unwinds, trend followers give back a lot. And that's really that's the space that I
Hmm.
try to operate in. So if I'm going to short, which I haven't done, but if I'm going to short energy, that's the one that I'm looking to short. So I'm looking for some kind of news failure there to try and short that. Another opportunity to me is the grains. This has all been very bullish grains too, right? Something like, I don't know the exact numbers, but some large percent of the fertilizers and the things that go into fertilizers, of potassium and all that, come out of that region. We see fertilizer prices, higher grain prices, higher food prices, all that. The one that is showing the most crowded to me is soybean meal. I don't know if you can pull that up. SM, I believe, is the chart.
Here we go.
Um, that's the one that's most crowded. We did have soybean meal futures go limit up in Shanghai last night, and this U.S. soybean meal future couldn't even get up. It was up maybe a dollar, maybe a dollar
Hmm.
and a half last night, while the Shanghai futures were up limit up. So that's the one. That's another way to possibly play the. I know that most people out there on here are probably not looking at soy meal futures, but just as a way that I'm looking at what I am going to get ready to do. Um, Another way to sort of play the energy coming down play. Now, clearly, the most obvious way that everyone's trying to play the energy come down play is get long the stock market. Get long the S&P. You don't have to worry about soy meal. Just get long the S&P, and that probably works. But if it doesn't, then I think we got trouble.
Hmm.
What
Yeah,
if
I
the
agree.
stock market can't rally with energy coming down? That's the question I'm asking myself.
Well, and there's always kind of things that will, in my experience, when things go bad, that's when things break, when liquidity comes out of the market. So let me just bring up a chart here of BlackRock. Do I have the right screen up here? Let me bring this up here. So they had to withhold redemptions for some of their private credit funds last week, and we already know OWL Owl, Blue Owl Capital. They've been weak for some time. They underwrite a lot of the data center stuff, which is not doing well because it's just too much debt. Investors are kind of worried. But even for BlackRock to see that kind of issue, just in my experience, that's when these are the environments where this kind of stuff starts to break, and then after you get this kind of domino cascading effect of troubles. Even if we take a look at the high yield bonds, which another indicator I watch very closely as well, this is something that I'd been pointing to all year. I don't know if you remember saying, hey, this is still trending higher. Well, this started trending lower early last week, and high yield debt, either due to the war or due to just weakening credit conditions internally, things like BlackRock or what. It's always hard to tell what it is. But this is one of my key barometers for liquidity, and this is now trending lower. I mean,
Question on that one.
yeah.
Both this one and the other one, HYG.
Hmm.
This is just showing the bond and not the spread, right? In other words, this is going down, but so is treasuries. So is this going down? What's the spread doing?
So this is not
I
the
don't know.
spread. This is just the bonds themselves. But what I do to make it like a total return look is I adjust for dividends. So it puts the dividends back in, or because if you don't, then it doesn't give like the true return of what
Can you
what
do
the
it relative to like the 10 years or something like
you
that?
could.
So we
You
can
could
get
do
an
like, let's say, a
idea on
JNK divided by let's say ZN here, or TLT. I could do TLT.
Eh,
I'm not sure if it's adjusting for dividends though. Yeah, I think it is. Yeah, so you can do it
that
this
would
way as
mean
well.
that spreads are widening. If that one's going down, it means spreads are widening because it
Yeah,
means JNK is going down more than TLT.
exactly, exactly.
That's the one that kinda interests me a lot, but yeah.
So yeah, I mean, this is I think they look at different things, but both both along the same spectrum. I just try and look for just general liquidity flows. I think this is like looking maybe for like a worsening of credit conditions, both important, of course. But something changed last week. Obviously, is the war, but is it just the war? Is it other credit problems? Hard to know. But again, if we're going to be getting ready for a big old bull market, like we had this weakness in October and then we kind of went sideways. We started trending higher and things got better for a lot of stocks again. So this is another thing that I'm watching very closely, which, like I said, in tough markets, things start to break, things that you wouldn't expect. And then that has a cascading effect, especially when it's credit that gets ugly really fast. Yeah.
I mean, I think I ranted on it last week, right? So I don't need to go into it again, but in general, yeah, governments need to borrow a bunch of money. Now you got private credit that's having trouble raising money, and now you've got a war that is costing a lot of money. I don't know what the limit is,
Hmm.
but clearly we're a day closer to that limit every time one of these things happens, right? Watching the market is going to be much more important than me guessing where is the limit. And I have no doubt. Oh, and then you also have the AI thing that needs to be funded, which, as you see, is being pulled back on now, right?
Yeah. The Stargate project there was kind of
Right. It's all being
back
pulled
over.
back on
Yeah.
because because of the credit issue. They can't look. A lot of that money was coming from those private credit firms, right? So where are they getting it from now? And at some point, I don't know. You talk about the market pushes the government to do certain things. You can make the argument that the market's going to try and push the government to print money again. You
For
know?
sure.
And if that's what it's going to do, it ain't gonna do that by going up.
Hmm.
You know? Like, they're not gonna print money because the stock market and the bond market and the dollar are going up. They're gonna print money because the things are failing, and that's not a prediction other than the fact that if those things do start to go down quickly, they will print money. And I say this all the time. That's what's so hard about being short things. Because you'll be short and you'll be laughing and you'll be making money and you'll be doing great. And then these guys will come in and say, we're printing freaking, a zillion dollars and this shit will rip your face off again. Right. So
there's one chart
why,
I do
why I
want to.
say being better to me for 99.999% of the people is just have dry powder rather than try and be a wise guy on the short side.
There's so much. I mean, I think every trader who does a lot goes through the same cycle. You go through a bad market, you say like, oh, I could have been shorting. You could have, but unless you're someone who that's part of like the way you usually. And some, I mean, I knew some guys they just always trade the short side. That was their process. That's the way they were built. That's what they structured their process on, and it worked for them. Though it was very difficult, but that's the way they worked from. But to think that you can, and I thought that, so I'm not trying to cast a stone at somebody else, or maybe it's my shortcomings, but to think that you're going to be able to be bullish in time, then get short at the top, then when all looks really bad, cover your short just in time, but then after the same time have the emotional awareness to find the best stocks and get long those stocks. It's a especially when markets are erratic and gappy, it's a very, very difficult mental and emotional thing to pull off. So just in my experience, but
Shorting the stock market is the single hardest trade there ever will be and there ever was. Right. First of all, you're fighting upward drift, which is just plain stupid. Right. Why would you want to fight upward drift? Second of all, even when you get it right, most of the time, it squeezes, and it's very difficult to at the bottom of the bear market, the market squeezes.
mhm.
But during a bear market, the market also squeezes. It's very difficult to know which one of those are. I've looked at them. They look exactly the same. The price movement, the volume movement, all of it looks exactly the same, except one ends up just being a false squeeze, and then we make new lows, and one of them ends up being the actual bottom. So it's very difficult to know which one of those is.
Mhm.
These things make shorting very, very, very difficult. It's very satisfying to make money on the short side of the stock market. I get it, but that's also probably why it's so difficult because you have to sit. It's very difficult. That's all I can say.
Well, also, I would just kind of, I mean, it depends what you're trying to do too, because everyone has different time horizons and the rest. But if you're going to position trade, like the asymmetry is always to the upside. I mean, I mean, there's no limit to how much you can make, but on the downside, if you catch a 15% S&P drop, or some stocks that drop 30, 40, it's great 30, 40. But I mean, we looked at stocks earlier this year that went up 40, 50, 100%, like LITE, Lumentum is up like 100% year to date. I mean, like it's very hard to get 100% short trade, in comparison. So you're fighting also the asymmetry of the way markets function. So again, maybe it's my shortcomings, but if it worked for you, power to you. But I think it's just a lot more difficult than people imagine it is. But there's one
And
chart I want to
the
kind of,
only way to understand that is to try it.
yeah,
You'll get it in time. I
one
used to
chart,
trade through it all the time. I loved it until it freaking bankrupted me.
yeah.
And look, the first time I ever bought a sports car was because of the money I made on a short. Okay.
So then it was
I
locked
loved
in
it.
your mind, I'm sure.
It was great. It was great. And then, you know, eventually it bankrupted me. So you'll get it. Try it. You don't believe me. Don't believe Matt. Give it a shot, man. Start shorting. You'll get it.
Instead of shorting, just my angle, what I do is I try and find those guys, either bucking the trend or first to be strong. One of the greatest stock moves ever was Cisco in the 90s. Like, just for perspective, this is like a regular chart, like arithmetic. This went from split adjusted from like 5 cents to $50. This is like, this never happens kind of thing. Like, incredible move, right? But just to kind of zero into like this is like the log chart just for comparison, what it looked like. But just to kind of take a look at why that 1990 example is so interesting. Let's go back to 1990. This is what I was doing with members last night. So we were taking a look at. If we take a look at that situation, the war, because my view is we're still in this AI productivity boom. Whether it's going to be everyone who wins or certain winners or whatever, there's tremendous innovation. There's going to be some spectacular companies that are building as we speak. These incredible things that are going to come out. They're going to come to market, or they're already on the market and they're being dragged down by the market, and they'll rip up the second the market stops. But take a look at Cisco back here. This IPO'd. This is when the war started, when Saddam invaded Kuwait. You had the big drop. I mean, this was not immune. Cisco. Cisco had what was this year? This is close only, but you fell 32%. So again, for everyone who just says, oh, it's a good company, hold on to it. Well, it's down 32%. And at this point, you don't know it's a good company yet. This is all you see. But then
Right.
after, just to kind of, for perspective, if you just kind of stay locked on what I've been talking about here, and what I always say is, a leader is a stock that goes either, should go up more than the market on the way up and down less than the market on the way down. Well, here the market is way down, and very quickly we're back to new all-time highs. So, in the middle of this kind of bear market of 1990, instead of getting overly fixated on the war and all the rest, if you were looking around at who's actually winning and able to kind of buck this weakness, this was the genesis, the very starting point of like one of the greatest stock moves of all time, which took place in the midst of a very, very similar conditions with a similar kind of technological backdrop and all the rest, and just incredible move. So just in the midst of this
That's a
weakness,
great example. You could have bought Cisco right there when it made the new high.
right here, boom! For
Did
look
you
where
lose
the S and
anything?
P
You're buying
was.
the thing at 7, 8 cents.
Yeah,
Okay,
boom, right here.
you didn't get it at 4 cents. You got it at 8 cents. A double. You bought it after it doubled. And then look what happened. Then you're a freaking millionaire.
Yeah, many times over. Right? And that's
Yeah.
the thing is if you focus on the asymmetry to the upside, the beautiful thing is you only have to really get it right once with some decent size. That means you could strike out a lot of times if you manage your risk, but at least you have that asymmetry. That the short side, that's the problem. You don't have that same kind of asymmetry working for you, so you have to be a lot more accurate, which is difficult in any market. But this is an example of like day to day. I know we all have that our fingers want to be on the trigger and look for ideas, but for me, until my things set up the way I do them, like this is what I'm seeking out. Like these are my pinup posters on my wall that I'm going to be looking at of like things that I hope to catch or things that are going to be doing similar type of things. And so it's worked in the past. That if someone knows the company is a great company with great, that's going to be worth a whole lot more, they're going to have to buy that stock, and you're going to see that outperformance versus the market. So for anyone who hasn't looked back and studied this, go back, and that should be like a pinup
The one
on
I
your
always
wall.
like is Amazon,
Hmm.
because Amazon, if I'm not mistaken, dropped 80%. Um,
After.com.
yeah.
Oh, here we go. 95%.
Okay. And then it was the first stock. This is how I always looked at it. If you just bought the stocks from the internet boom, and Amazon was just another one of them at the point. At that time, it was just another pets.com. They were selling books and they were selling CDs. That's what they were doing, right? They weren't in the cloud yet. They weren't any of that shit, right? If you had just bought the stocks that went through their all-time high, the first ones to go through their all-time high, I'm pretty sure Amazon would have been the first one to do that.
Yeah. That
Okay,
was
so
at
you bought it
$5.
there. So you bought Amazon right there, $5. How'd you do on that one?
Well, we're trading $200, so it's not a bad trade for Amazon over 15 years.
5 to 200? It's not too bad, right?
Yeah.
So it's the same story. I mean, we talk about it all the time, but I've never done it. But you go back and if you could group in 2000 all the stocks that were, let's call them internet bubble stocks, which Amazon was one of, right?
Well,
And
eBay
then
was
you,
one that was
and then
one of
you
the
just
first to
bought the
come back.
ones that went through their all-time high when they went through their all-time high after the internet bubble broke. You probably did okay.
Mhm.
Remember JDSU?
Well, that is, Viavi, which is something I've been trading.
Now it is, yeah.
This is what JDSU. I mean, look at these moves. People, I think, that's the funny thing. Everyone was calling for AI bubble last year, and to some extent, some stocks maybe did, but I had a hard time accepting that argument because if you go back and you look
They
at
didn't do
bubble
what these
stocks,
things did. Yeah,
like
they didn't.
this is these were bubbles. Like never mind, like stock doubled or tripled in 4 months. It's a bubble,
No,
tripled.
I've been saying all along that you can call this a bubble, and look, maybe history will show that it was, but don't tell me this is 2000.
Yeah,
I was in the middle of
exactly.
2000. This ain't 2000, man.
Look at
You
this.
wanna know what 2000 looks like, go look at what these JDSU did. Go look at what Cisco did. Go look at what these stocks did, right?
Qualcomm.
What's the Canadian one? Northern whatever,
They're
North
bankrupt now. Northern
huh?
Telecom, Nortel.
Yeah, Nortel. They're bankrupt.
Yeah.
But I my friend's girlfriend was a salesman there.
Mhm.
We were, like, in our 20s. She had something like $40 million in stock options on paper.
That was such a fiasco. The CEO, when he left in 2001 or 2, Roth was his name. I think he took like $400 million back then. And it's not like he founded the thing. He was just CEO for a few years. And they've changed all the pension laws since then because I have a lot of family members worked at Nortel, it was the biggest company in Canada, and all their pensions got cut because the pension money was kind of like commingled with company assets, so they ended up kind of hitting all the pensions as well. So they've changed all the laws since then, but just wild. And to put it in perspective, I have a good friend of mine who works at the exchange here, and he was just saying how back then it's like they were thinking of making like pits. There was still the floor pits, like making pits just dedicated to trading Nortel stock for how much action there was. And just to go from that to bankrupt, like not many years later, just there's no sacred stocks in the market, and everyone is susceptible if you get caught in the wrong thing.
But if you use your stop losses, you don't get caught.
Well, so okay, funny with that. For first of all, if you're enjoying the conversation, like, subscribe, and all the other good stuff. You can, but also if you'd like to ask a question, you can go to marketsunscripted.com. You can ask us a question. We're going to try and cover one each week. We had one come in from Jay. And so speaking of stop loss, he asked the question. He's like, well, if you guys say you're wrong all the time, and I think we're like, my win percentage is, I don't know, maybe 30%, 30s. It's not, I'm not 50,
Why don't
that's for
you just
sure.
take the opposite side?
Why not take the opposite sides? You look like you want to rant a little bit, Jason. I'll let you start
I mean,
though
I
this
hear that
morning.
all the time, and, it's ugh.
He
My
means it
wife
from a
always
good place,
my wife
Jason.
always tells me, "In through the nose and out through the mouth." 36% of my trades work, okay? Which means 64% don't work. But the point is I lose $1 on the ones that don't work, and I make $5 on the ones that do work. So if I were to do opposite that, then I would have a higher winning percentage, and I would lose money. I'm not in this game for winning percentage. I'm in this game to make money, right? So that's the simple answer that has to be understood when asking that question. Um, that's as simple as I can answer that question.
But in my experience, any professional I've dealt with or spoken to, everyone that I know, unless you're a market maker or someone who has like a structural advantage. So like when I was a market maker, like you had a structural advantage. So I had north of 50%. We had actually they covered it in Flash Boys where they called it something like zero plus. I forget what they called it, but like again, everyone had similar strategies where basically you'd put on a trade. If there was enough liquidity, if it didn't work, you'd get out flat. But if it worked, you made the spread. So you either broke even or made money most of the time. Every once in a while, you get caught, sandbagged. The big seller would come and you'd lose money, whatever. That's the situation. But so if you have a structural advantage, I think those places you could have, and look, machines ate all that business up anyways, but you could have had a high win percentage in that kind of an operation. I've never really met someone who trades for a living or whatever, or runs money that has a 55, 65. Like I would be very doubtful if someone had an 80% win rate that they've been doing it for a long time. Just my experience. And if you're again, if you're out there, power to you. It's my failings, but the strategy is so susceptible. If you have an 80% win rate, I mean, it has to mean that your gains are probably smaller, or if anything, maybe just slightly bigger than your losses. Usually, it means they're smaller. So that means if there's any reduction in your win rate at all, you very quickly become a losing trader. So it's a
Every money manager worth their salt says the same thing. Okay. So, I mean, Stanley Druckenmiller says his win rate's 30%. He's the greatest money manager of our time, I would argue. Returned wise, if you look at his returns, that's just a fact. And it makes sense. Be logical. Be logical. It makes sense. There's a reason. If you're playing baseball and you're swinging for the fences,
Mhm.
you could get a lot of home runs, but with that comes a lot of strikeouts and not a high batting average. Now, my boy Aaron Judge is maybe the exception. He led the league in home runs and batting average last year.
My boy too,
That's
Big
because he's a
Daddy.
Yankee. That's because he's a Yankee. But in general,
I knew
okay.
I liked you, Jason.
No, in general. But look, and even though he led the league, he still bats, in the 300s.
Yeah.
Um, if you're swinging for the fences, which is what essentially I'm doing because I'm looking to make $5 and lose one, right? Then your batting average is going to be lower. That's the simplest way that I can say it, right? Um, so that's why I don't do the opposite of what I do and have a higher win rate. That's why I don't do it.
And I think that's one of the number one traps, unfortunately, that I think gets most people trying. And Jay's question comes from someone obviously they listen to the podcast and they want to learn, like they're trying to get the
Yeah.
reality of it. But it's one of the number one way. I think if I was watching someone a YouTube and they're talking about high win rate, I think it's one of my number one red flags. Besides them flashing like P&L screens on the screen, one of the top red flags I say is if they're telling you they have a 90% win strategy. I don't know. I'd be running for the fences. I don't know about you.
I think all of YouTube is for the most part is a fucking red flag. I mean, I get this one of the people who does this shit, somehow I'm on his email list and they send me every week. Another great week on our thing. We had 95% winners, out of 45 trades. We won and it says it specifically. We had out of 45 trades, we had 43 closed winning trades. 43 of our 45 closed trades were winners. They just don't talk about their open trades because they just never take a loss. So they never closed a trade, right? And so they blow people out. The email looks great. Oh my God, I should join. They have fucking 95% winning trades. They don't have 95% winning trades. 95% of the trades they closed were winners.
If you never close them, you never lose.
If you never close them, you never lose, except when you're trading real money.
Yeah.
I mean, this same guy, by the way, was one of the people who was selling crude oil,
Mhm.
who was suggesting selling crude oil on Sunday, right? Which maybe worked for him, but he kept it open. Well, crude oil went from whatever 70, to
20.
90 plus
Mhm.
over the next 4 days, right? Believe me when I tell you that loss right there made up for any of the closed winning trades that he wants to claim. So that's the answer.
So if anyone wants to leave any other questions to anger Jason next week, please go to marketsunscripted.com. We'll rile him up.
Not
We'll get
hard to
him
do.
good to go.
It's not that hard to do.
Well, we're going to check back next week. We're going to watch all those important data points. We're going to see, interestingly, how the NASDAQ has more commercials buying NASDAQ versus small caps, like we spoke about. We'll check out how the NASDAQ does versus the XLP. We'll keep an eye on that JNK ETF and the up down volume ratio. Just some tools I'm going to be watching, and I think it's just going to be the day to day. What news comes out? How does the market react? Now the G7 put their hand out there that they're going to release oil barrels from the Strategic Petroleum Reserve. It's a stick save today, but does it stick going on from here? That's gonna be what we're gonna have to watch, and the lows of today are gonna be very, very important. So, with that, Jason, thank you so much again for another fun time chatting, and we'll be back again next week.